To my channel. I am Doris and I'm here to share with you about my stock account and today's market performance. Today my account lost $5,734 on my account. Number 2, US stocks close high. Nasdaq Composite 4 straight gains. The market awaits CPI data. So let's take a look at my account right now. Currently the net asset of my account is $87,033.89. Just by today, I made a loss of $5,742.3, and that's a negative loss. That's a loss of 6.19%. And in total, my account has made a loss of $14,142.57. And this is due to the rise of market today. Today, SQQQ as the short of Nasdaq Composite has decreased by 5.14% to $47.46, while DRV decreased by more than 10% to $44.2. And then let's take a look at the market today. Today, all of the 3 market indexes showed an increase. Dow Jones Industrial Average showed an increase of 0.8% to 33,973.01. Nasdaq Composite showed an increase of 1.76% of $189.04 to $10,931.67. And S&P 500 showed an increase of 1.28% to $3,969.61. And looking at the industry heat map, we can see that the internet, the technology stocks showed an increase of more than 2% today, and many other industries showed a relatively smaller increase. Overall, the market is doing well. Economics, polled by the Dow Jones Institute, expect CPI to rise 0.1% month-on-month and 6.5% year-on-year in December, signaling a cooling of inflation. In addition, the Economists expect core CPI, which excludes food and energy prices, to rise 0.3% month-on-month and 5.7% year-on-year. Moya, senior market analyst at Oanda, said U.S. stocks rose slowly on Wednesday as optimism still dominates the market, and investors expect key inflation reports to come to show that the deflation slowdown trend remains. U.S. Treasury yield retreated on Wednesday as investors awaited Thursday's CPI report. Senior investment strategist at Bernstein Private Wealth Management said, "I think it'll be difficult to try to determine when the Fed will finally start cutting rates. There is evidence that market conditions will be better going forward when the Fed starts cutting rates, but it's only mid-January, and at this point in time, it is too difficult to tell whether the Fed will cut interest rates in 2024 or by the end of 2023. Markets are still closely watching the Fed's monetary policy outlook. Fed Chairman Jerome Powell's first speech of the year on Tuesday highlighted the need for central banks to maintain their independence. He pointed out that price stability is the cornerstone of economic health, and that when inflation is high, central banks may be needed to take some unpopular measures, namely rising interest rates. Market analysts believe that although Powell emphasized the Fed's goal of stabilizing prices, he did not actually make a clear comment on the outlook for monetary policy. CME Group's Fed Watch tool also showed that the market expects the probability of a 25 basis point rate hike next month at a recent high of 77.2%. The probability of a 50 basis point rate hike is less than a quarter. Richard Fisher, a former Dallas Fed president and now a senior advisor at Barclays, said the Fed may go too far in raising interest rates because it is embarrassed by its previous miscalculation of inflation. The Fed does not want to be wrong again and again, and it's embarrassing that their inflation transitory theory has been proven wrong, Fisher said. So the last thing they want is to make the second mistake, which is to stop raising rates too early. Will this take them too far in raising rates? I think so. CEO of Two Line Capital, known as the new king of bonds, recently said that investors trying to figure out how the interest rate situation will develop in the future should pay more attention to the bond market than to the Federal Reserve, which he believes controls the direction of interest rates are in the hands of the bond market. He also cautioned to pay close attention to the inversion of U.S. Treasury yield curve, which has successfully predicted recession several times in the past. An inverted yield curve always correlates with a recession in a relatively short period of time, he said, adding that many bond investment strategies have significant upside. Overall, he sees bond assets as more attractive than stocks. This is reflected in his investment view, which he believes investors should currently favor a portfolio of 60% bonds and 40% stocks over the converse. More traditional portfolio of 60% stocks and 40% bonds, and he believes that investors have no advantage in allocating a larger share to stocks in the current macro environment. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.